If you want to become an intelligent investor like Warren Buffett, it would be smart to learn from what he considers the best book on investing ever written. Let's get into it. This book is about value investing, which focuses on investments that are either underpriced or are fairly priced. These investments have great expectations for growth. In value investing, you do not invest in companies whose stock prices are far overpriced, no matter how great the company is. The intelligent investor removes all emotions from investment and uses only logical and practical ways to evaluate investments. Do not invest in a company just because you feel good about it. Invest in a company because there is a logical expectation of growth and stability. The intelligent investor does not let the roar of the crowd sway his own judgment, and he never stoops to the level of irrationality of the market. It's easy to get excited about a rising company, and even easier to get upset about a falling company. Do not let temporary market fluctuations cause emotional you to make rash decisions. Reevaluate and reassess the investment, and more than likely you will find that the market is overreacting. While it may seem easy to foresee which industry will grow the fastest, your prediction has no real value if everyone else is expecting the same thing. By the time everyone decides that a given industry is obviously the best choice to invest in, the price of its stocks have already been bid up so high that its future returns have nowhere to go but down. Think about Amazon or Netflix. These companies obviously were foreseen to be highly emerging industries, and the companies themselves are great, but their stock prices are so absurdly overpriced that it would be foolish to purchase them now. The intelligent investor understands that stocks become more risky, not less, as their prices rise, and less risky, not more, as their prices fall. Understand that prices can be too high to purchase a stock. Do not purchase a stock if the price already reflects the expected growth of that company. Graham recommends to not purchase stocks that have a PE ratio higher than around 25. A PE ratio is the price you pay per $1 of earnings made by that company. At a 25 PE ratio, you invest $25 per $1 the company makes. At a ridiculous PE ratio like that of Amazon, you may invest $250 per $1 the company makes. Clearly you can see how overpriced stocks can become. At a PE ratio of no more than 25 to 30, the slightly higher prices may be compensated by the expected long-term growth. We must always invest and never speculate. Investors thoroughly analyze a company and the soundness of its business. Investors deliberately protect themselves against serious losses. And investors aspire for adequate, not extraordinary, performance. Investors judge the market price by established standards of value, while speculators base their standards of value upon the market price. The key to investing is always viewing the stock as a real company, not just a price ticker that goes up and down. Graham recommends you only invest in companies that you would be comfortable with not knowing its daily share price. We should look for companies that are inherently sound and promising, and companies that are not popular on Wall Street. Oftentimes, a stock may be undervalued simply because of lack of interest or an unjustified popular prejudice. Think about Facebook and the Cambridge Analytica scandal. Facebook was a fantastic company, but the scandal made fools panic and sell off the company until it dropped nearly 20% in value. This was the perfect time for the intelligent investor to buy, and sure enough, the price shot back up within a month. Graham always reminds us that stocks do well or poorly in the future because the businesses behind them do well or poorly. Nothing more and nothing less. Never delude yourself into thinking that you're investing when you're speculating. Don't hop on a company that stock rose 500% without justified reason. And don't buy Bitcoin because everyone else is buying Bitcoin. Use your judgment. Use your logic. The intelligent investor never forecasts the future solely based on the results of the past. This is a common problem that investors make in a bull market. Graham urges us to ask a few simple, skeptical questions. Why should the future return of stocks always be the same as their past returns? When every investor thinks stocks are guaranteed to make money in the long run, won't the market end up being wildly overpriced? The more enthusiastic investors become about the stock market in the long run, the more certain they are to be proved wrong in the short run. The value of any investment must always be based off the price that you pay for it. You must never overpay for an investment, especially in a bull market. It is common belief that as you are young, you should make riskier investments, and as you are older, you should make safer investments. Graham doesn't believe this principle. He thinks that the rate of return should be dependent on the amount of effort you are willing to put into your investments. This means the passive investor will receive the minimum return, but receives both safety and freedom from concern. Meanwhile, the active investor, who displays high intelligence and skill, will receive maximum returns. It has nothing to do with age and everything to do with the amount of effort you want to put in. I'll have a more detailed video on setting up a portfolio as a passive and an active investor. Graham believes that all kinds of investors should invest using the dollar averaging strategy. This strategy is to invest the same amount of money into the market every month. When the prices are high, you will get less. When prices are low, you will get more. Consistent investing over time is what will yield you large returns. You should not just wait for prices to crash to buy all of your stocks, because this time may not come anytime soon, and that lost time could lose you a lot of potential money. Lastly, let's focus on market fluctuations. It's easy to tell you not to speculate. The hard part is for you to follow the advice. The average investor cannot predict market changes much better than the public. It's very likely that your portfolio will raise high and drop low within a 5-year period. Market fluctuations create heavy emotion among investors. You must learn to control your emotions or you can never become a successful investor. When prices skyrocket, do not be swayed by the overconfidence and enthusiasm of other investors. Do not buy overpriced. When prices tank, do not panic sell your investments at prices below their real value. Certain stocks may skyrocket to a price that does not match their true value due to optimism, or crash to a price that is much undervalued due to pessimism. Understand that the market is not always right, and you can take advantage of this when available. Note this important fact: the true investor is rarely ever forced to sell his shares, and at all other times he is free to ignore the current price quotation. You only need to pay attention to the price and act upon it when it suits you, when it is a favorable time to buy or sell. It can be better off to look at your investments with no price tag, so you are not swayed by other people's mistakes of judgment. Understand, having a price on your stocks gives the investor certain options that he does not have when the security is unquoted. Some days you may see a good opportunity to take advantage of a certain price, while others you may disagree with the price and ignore it. Overall, Graham believes it is best to buy stocks whenever you have the money to put into stocks, except when the general market price is higher than can be justified by true values.